Hello, I'm Carrie Dara with Grove Cedar Valley. I'd like to welcome all of you to our webinar today. And today we have a really good, we've got experts to help us, and we've got a really good topic that we know is on the minds of many of you and businesses about the current tax implications due to COVID-19. And I know we're thinking about that, but do we even know where to start to think about that? So we have Chad Abbas with us and Michelle Weber from BerganKDV to share some information with us, because you know, COVID-19 has impacted many aspects of business operations, with the largest obviously being financially. So how do we recognize those tax implications in the changes that can be taken advantage of, and more? So I will turn this over to Chad and Michelle. Thank you both for helping us work through this. And I know it'll be great information for our audience, so I'll let you take it away.
Okay, thank you, Carrie. Good morning, everybody, and thanks for viewing today. I'm going to dive right in. So way back on Friday, March 27th, 2020, the President signed into law the Coronavirus Aid, Relief, and Economic Security Act, known as the CARES Act. The CARES Act contains a number of relief provisions, including tax provisions, and the law is very complex, and so I will talk about some key individual tax provisions included in the law. First up is the rebates for individuals, or popularly known as the stimulus provisions. These payments are actually refundable tax credits against 2020 taxable income. So they will be reported and reconciled on your 2020 income tax return. The payments were $1,200 for individuals, $2,400 for joint returns, plus $500 for each qualifying child for purposes of the child tax credit. This generally includes dependent children under the age of 17 that have a Social Security number. Not everyone received a stimulus payment, because the credit begins to phase out if a taxpayer's adjusted gross income, or AGI, exceeds $150,000 for joint returns, $112,500 for filing head of household, or $75,000 for all other filers. How did the IRS determine how much to pay? They first looked at the 2019 return on file. If that return has not been filed, they went back to the 2018 return. If a return was not filed for either year, alternative procedures were issued how to obtain the payment. So how does this come together on your 2020 return? The payment received is reported and reconciled on your 2020 income tax return. But the good news is you will not be required to repay any payment received. So, for example, if you receive the full $2,400 as a couple based on your 2019 AGI being under $150,000 and your 2020 AGI exceeds $150,000, you will not have to repay it. If, however, you did not receive a stimulus payment at all, you have another chance to receive it based on your 2020 tax return criteria. It will be treated as an offset against your 2020 tax liability or as a refundable credit. The next topic is a new charitable deduction available in 2020 for people that do not claim itemized deductions. The CARES Act allowed up to $300 in charitable contributions made to qualified charitable organizations as an above-the-line deduction, which means before AGI. Any amount that exceeds the $300 may not be carried forward, and the $300 limit applies regardless of filing status. So single, married filing joint, all filing statuses have the same $300 limit. The contribution needs to be made to a public charity, commonly a 501c3 organization, and the contribution must be made in cash, check, electronic, or payroll deduction. So contributions like clothing donations to Goodwill are not qualified for this special deduction. Overall, the $300 may not seem like a lot, but it might be very helpful to struggling charities right now. Next up are some new special rules for retirement plan distributions. Generally, if you dip into your retirement plan before age 59 and a half, there is a 10% early distribution penalty on top of the regular tax that applies. The CARES Act allows a taxpayer to take up to $100,000 in distributions from a qualified retirement plan without being subject to the 10% penalty, if that distribution is coronavirus related, which is broadly defined. The exception only applies to distributions during 2020 to individuals diagnosed with COVID-19, individuals whose spouse or dependent was diagnosed with COVID-19, or individuals who experience adverse financial tax consequences as a result of being quarantined, furloughed, or laid off, having work hours reduced due to the virus, being unable to work due to lack of childcare due to the virus, or closing or reducing hours of a business you owned or operated. That's a mouthful. Like I said, the exception applies to a lot of situations. In addition, if an individual takes a distribution, they may pay it back to the retirement plan within 3 years. Also, the taxpayer may include the income from the distribution in gross taxable income equally over a period of 3 years, or all of it in year 2020. To summarize, if you meet the criteria, the distribution will not be subject to the 10% penalty. You may repay it within 3 years and not have it taxed, or include it in taxable income equally over 3 years, or all in year 2020. There are more retirement plan provisions in the Act. If you are already taking distributions from your retirement plan because you are over age 70 and a half, or due to the Secure Act age 72, the CARES Act is giving you a pass on that for 2020. The required minimum distribution, or RMD, is waived for 2020 because the amount was calculated in 2019 when the markets were high, and then distributed in 2020 when the markets were possibly lower. If you took your RMD early in the year before passage of the CARES Act, you had the opportunity to pay it back before August 31st. The RMD requirements will resume in 2021. There is one more provision I'd like to bring up regarding retirement plan distributions. This is not a new law, but if you have an IRA account and are over 70 and a half, you may give up to $100,000 directly from your IRA to a qualified charity or several charities each year. This is called a qualified charitable distribution, or QCD. The QCD is not included in taxable income, so there is no charitable deduction. This then allows the taxpayer to take advantage of the higher standard deduction instead of itemizing deductions. It is a win-win in a lot of cases. To pivot now, believe it or not, unemployment benefits are taxable. That's right. Unemployment benefits must be reported on your income tax return. If you received unemployment benefits as well as the additional $600 or now $300 per week in coronavirus relief at any time during the year, your tax return will be affected. Some people collected unemployment benefits for the first time ever in 2020, and that included some self-employed workers. You will receive Form 1099-G from your state unemployment office that reports your 2020 benefits. You can choose to have federal and state income tax withheld from your unemployment benefits, but many do not. There may be a big surprise for some when their 2020 tax return is completed with tax owing instead of a refund due to the taxable unemployment benefits. The 2020 year has been very challenging so far, and that extends to the tax law. It's more important than ever to do some year-end planning with your tax professional. And with that, I will do a handoff to Chad, who will inform you of some new and exciting business tax provisions.
Thank you, Michelle. Good morning, everyone. As we discuss some of the 2020 tax provisions that affect businesses, we certainly need to begin with the Paycheck Protection Program, otherwise known as PPP. I'll start first with some background on that, and then we'll get into some of the updates and some planning opportunities surrounding the PPP program. The PPP program was the cornerstone of the coronavirus aid, relief, and economic security, the CARES Act that Michelle referred to earlier. Remember, the general guidelines of the PPP program were released in late March. We had approximately a week to file for the PPP, file the PPP loan application form. We anxiously waited for that form to be released, knowing that there was $349 billion set aside for program, and it was a first come, first served basis at that time. There was a race to file with your bank as soon as possible, which is April 3rd or shortly thereafter, because the SBA began to allow applications to be. Never before have I ever witnessed a government incentive with such a large impact be implemented so quickly from the introduction to the filing. So that initial $349 billion, that expired then, or it was used up by early May. Congress then approved an additional $320 billion that the deadline was June 30th, 2020 for those that had not yet applied. This deadline was later extended to August 8th, which is when it ended. So now that we're past that PPP application process, let's focus on what the ultimate benefit of this program is, and that is the potential or hopeful forgiveness of the PPP loan. The PPP loan forgiveness is generally based on three items. The first is, what are the loan proceeds spent on? The second is, to what extent the business kept or maybe rehired its employees. And then lastly, to what extent the business maintained the level of pay and the level of hours of its employees. So if we first talk about the FTEs, the FTEs is something that you've probably become familiar with in this process, but it means full-time equivalent employees, and that's based on a 40-hour work week. And so when the PPP program came out, it was generally based on the fact that if your FTEs went down, you weren't going to be able to have 100% of your loan forgiven. In addition, in order to be 100% forgiven, the business could not reduce the rate of pay to its employees by more than 25%. And this is looked at on an hourly rate basis, or in the case of a salaried employee, on their per pay period basis. So then the PPP loan proceeds had to be used for qualified expenditures. And those qualified expenditures include payroll costs, which are, of course, wages, but then also the employer's share of benefits. They include utilities, and they include mortgage interest. These qualified expenses originally needed to be incurred within an 8-week period. So that was later extended to a 24-week period. And with that increase to the 24-week period, we really see most businesses, certainly a lot of the businesses, should be able to meet the qualifications to have the entire loan forgiven. Businesses technically do not need to wait until the end of the 24-week period to file for their forgiveness. They can file the application as soon as they feel they've determined that they've met the necessary requirements to have the loan forgiven. However, that being said, there are many reasons to remain patient and not rush to file the forgiveness application. Throughout the PPP season, which is kind of it's kind of like a tax season, this whole PPP process has kind of been a PPP season. Additional guidance has trickled out. As a result, we continue to work with a target that continues to shift. So unlike the application process, where that was very swift. I mentioned the bill was enacted, and a week later, we were applying for those, we were filing those PPP applications. Unlike that, the information for the forgiveness has trickled out very slowly. And so it's made it a challenge to try to get our arms around that. So even though most businesses are anxious to file the forgiveness application, patience is still advisable. So a couple items have occurred within recent months that I want to bring to your attention. There certainly are more than this as well. However, I just want to be aware of maybe a couple more wide-ranging impacts in regards to the PPP forgiveness process. First of all, obviously the forgiveness application forms have been released. There are two forms, a regular form and then an EZ form. The EZ form is available if your FTEs did not decrease. But a couple other items have passed or have been clarified in recent months too that are important. One includes the compensation of an owner. So if you recall, when you filed your PPP application, anyone who was paid in excess of $100,000, your wages on an annual basis were limited to $100,000. You also will remember that that application was for 2.5 months worth of your 2019 payroll. So if we look at an owner, the amount to be treated as a qualified expense for an owner's salary is limited to $20,833, not 24 weeks of payroll for them. That $20,833 is arrived at by taking $100,000, the maximum compensation for a year, and then taking 2.5 months of that equivalent pay. And that's how we get to $20,833. One additional item that may affect quite a few businesses with us today relates to rents paid to a related party. Many businesses that we do work with that we see across the area have a related company or have a related individual that owns the real estate. If you have a situation, understand that the rents are eligible. However, it's limited to no more than the mortgage interest that is paid by that related party or that related individual. So you may be paying a large amount of rent over to that related party. However, be advised that though that entire amount of rent is not a qualified expense, it's going to be limited to what the mortgage interest is that's paid during that covered period by that related party. And one other thing to point out is that in regards to rents, the lease needs to have been entered into prior to February 15th of 2020. So you need to have a written lease entered into prior to that. So as we look at the PPP loan forgiveness application, the way it's laid out currently, it is important to note that even though the original thinking was that if you had a reduction in the FTEs, your full-time equivalents, that you couldn't have 100% forgiveness of the loan, the way the forgiveness application is laid out, even if you have a reduction in the FTEs for your business, you can still reach 100% forgiveness by increasing the amount of qualified expenses that you have. So if you were to file the application after 12 weeks, and in looking at the numbers, your total qualified expenses exceed your loan amount. However, because you've had an FTE reduction, maybe you're at 90% of what your FTEs were before. So when you multiply those qualified deductions, those qualified expenses by 90%, that may be less than what your loan amount was. So as a result, you would not have 100% loan forgiveness. So if that's the case, instead of filing after 12 weeks, wait for week 13, wait for week 14, wait for week 15, whatever it takes to get enough qualified expenses so that when you multiply it by your FTE factor, you will be able to get 100% forgiveness that way. Another piece that we're all interested in finding out more or getting more clarification around relates to whether the loan forgiveness is taxable or non-taxable. And many of you probably remember that when Congress passed the PPP program, it was their intent that the PPP loan forgiveness be non-taxable. However, the Treasury, the Treasury issued a notice, and that stated that expenses paid with forgiven PPP loan proceeds, such as payroll costs, will become non-deductible. At this stage, in order for the loan forgiveness to be non-taxable, it will take congressional action to do so. So understand that if we lose a deduction, it's treated the same as if we had additional taxable income. So in order for that to change, Congress is going to have to specifically act on that. And there are proposals being debated right now in Congress, in the House, and the Senate, that include the provision to have this PPP forgiveness income be specifically excluded from being taxable. The problem is that the House and Senate have not been able to come to an agreement on this new legislation. There was hope that an agreement could be reached when they reconvened after Labor Day. However, we're now at September 17th, and the popular thought now is that new legislation may not be passed until a new Congress convenes in January. Obviously, that makes it difficult to plan for this year when we may not know the ultimate deductibility of these expenses until the year is over. If I were to bet right now, I would guess that the expenses will remain non-deductible. If that's the case, let's assume the PPP forgiveness is not filed for and not granted until 2021. You know, that you wait until 2021 to at least obtain forgiveness. That raises a couple questions that you need to be aware of that we don't have the answer to at this point. Are the expenses non-deductible in 2020 when the expenses were incurred, since that's when your 24-week pay period or 24-week covered period would have existed? Or would that be non-deductible in 2021 when the forgiveness is actually granted? Again, questions that we're anxious to get clarification on as we plan for our clients' year ends. One other item to consider from a tax planning standpoint is whether your business qualifies for any tax credit that are dependent upon an employee's wages. Examples of these would include a work opportunity tax credit, the research and development credit, and the tip credit. So because the payroll paid to qualifying employees would be reduced by any PPP proceeds that are forgiven, you should consider not including those employees that would be eligible for these credits or that would allow you to be eligible for these credits. Consider not including those employees in your PPP loan forgiveness application. That would then allow you to still take those credits, the work opportunity tax credit, the R&D credit, the tip credit on your tax return. And with the 24-week covered period, hopefully you'll still have sufficient qualified expenses, qualified costs to still have the PPP loan 100% forgiven. So that's something that I'd encourage you to look at there. So let's further complicate things one more time, and I apologize for this, but let's again assume the expenses paid for the forgiven PPP proceeds are non-deductible. And again, that the loss of these deductions means your taxable income will increase. From a planning perspective, if the non-deductibility of those expenses is tied to when the forgiveness is granted, you know, when you apply for it, when you're ultimately granted the forgiveness, do you want that forgiveness to be postponed until 2021 so you can postpone the tax effect as far as possible? You certainly may want to. However, you may prefer to have the forgiveness take place in 2020 so that the increased income occurs in 2020. You may have a down year this year because of COVID or because of other items related to COVID. Also, knowing that there could be a new president. We don't know the answer on that, but if there is a new president, rates certainly aren't going to be any lower than what they are now. We don't know what they're going to be, but I think we can all agree that if there's a change in the White House, the rates are probably going to stay the same or go up. They're not going to be any lower than what they are right now. So it may be worthwhile to have those proceeds be taxable, those forgiveness proceeds be taxable this year. So as you can see, there are many things to think about and many items that we are anxious to get additional clarification on. However, once again, our advice is to remain patient and file the forgiveness application. And lastly, in regards to the PPP, one more reason to maybe stay patient is the fact that there is also additional legislation being debated on having PPP loans under a certain dollar amount be automatically forgiven. And that amount right now that's being bantered about is $150,000. Whether there's going to be a automatic forgiveness of debt at a certain dollar amount, or whether it's $150,000, we don't know the answer. However, it's certainly going to simplify your process and the bank's process of the filing for the forgiveness if you hold off and kind of see where that may be, if you have time. So that's kind of what we have for the PPP. I'm sure there's lots of questions on that, but let me dive into a couple other items that have an impact to 2020 for businesses. The first one is the Family First Coronavirus Response Act, and that was signed a little bit before the CARES Act, about 10 days before the CARES Act. And that allows the ability to get tax credits for employers for qualified emergency sick leave and family medical leave. This is available for employees who you're paying who are out due to COVID-19 or related items to COVID-19. And you can get a credit up to 100%. There are some limits, but generally up to 100% of what you're paying them. Or maybe employees that needed to stay home and could not work because of school or the child care center being closed. In that particular case, you can get a credit of up to 66 or 2/3 of what you were paying them. Now, keep in mind that any wages used for the PPP forgiveness application cannot be used for this credit as well. Lastly, item I wanted to make you aware of is there has been an expansion in the rules in regards to a net operating loss for taxpayers. And given 2020 and the frustration and the complexity and the issues resulting around 2020 with COVID, there may be businesses out there that certainly have net operating losses. And if that's the case, there's some benefit there, additional benefit there. The Trump Tax Act back in 2017 limited the ability to deduct net operating loss and eliminated the ability to carry back a loss. I should say limited the ability to deduct and eliminated the ability to carry back. The CARES Act expands the ability to take a loss and allows a net operating loss to be carried back from years 2018, 2019, 2020. So what that means is if you had a loss in 2018 and 2019, you should consider carrying back that loss and getting a refund on that if you're able to. And then that can convert that loss into cash for you sooner rather than waiting to carry that loss forward and getting a tax benefit in future years. So from a business perspective, that's all I have for today. We certainly hope we've shed some light on some information that may be useful for you. And if nothing else, maybe expand your thinking when it comes to planning for this year. We certainly hope everyone remains healthy. Thank you for listening. And if you have any questions, feel free to reach out to us. We'd be happy to help. Thank you.
Thank you.